Hey there, I've got some fascinating insights to share about the Fed's recent decision to hold interest rates steady. You might be wondering, why is this even important? Well, get ready for a deep dive into the world of monetary policy and its impact on our economy. So the Federal Reserve just decided to keep interest rates unchanged, which is a pretty big deal considering the current economic climate. What makes this really interesting is the fact that three officials actually wanted to increase rates. Now, this might seem like an internal debate, but it has huge implications for all of us. You see, when the Fed adjusts interest rates, it's like a ripple effect across the entire financial system. The Fed's decision to hold rates steady is a bold move, especially with inflation being so stubborn. Usually, raising interest rates is a go-to strategy to combat high inflation. But here's the twist. The Fed has kept rates unchanged for the fifth consecutive meeting. That's a long time in the world of economics. And this decision is even more significant because it's the second meeting under the new chair, Kevin Warsh. Talk about a challenging start to his tenure. What many people don't realize is that this decision reflects a deep divide within the federal. On one side, you have officials who are concerned about the persistently high inflation rate, which has been above the Fed's target for over 5 years. That's a long time to be off target. On the other side, there are those who believe that raising rates too soon could hurt the economy's recovery. It's a delicate balance, and the Fed is walking a tightrope here. The stock market's reaction is a clear sign of investor anxiety. When the Fed keeps rates low, it can encourage more borrowing and spending, which is great for businesses. But if investors start worrying about inflation, they might pull back, causing stock prices to tumble. And that's exactly what happened here. This raises a deeper question. Is the Fed's decision a short-term fix that could lead to long-term economic instability? Personally, I find this situation intriguing because it highlights the challenges of managing an economy. The Fed's job is to balance inflation and economic growth, but it's like trying to solve a complex puzzle with constantly changing pieces. Every decision has consequences, and the Fed's current dilemma is a perfect example of that. In my opinion, this situation also underscores the importance of long-term economic planning. The Fed's decisions today will shape the economy for years to come. It's a reminder that economic policy is not just about the present, but also about the future. So while the Fed's decision might seem like a pause in the action, it's actually a critical moment in the economic narrative. To wrap up, the Fed's decision to hold interest rates steady is a fascinating episode in the ongoing economic drama. It reveals the complexities of monetary policy and the challenges of managing an economy. So the next time you hear about interest rates, remember that there's a lot more to it than meets the eye. It's a delicate dance, and the Fed is trying to find the right rhythm. Stay tuned, because the economic story is far from over.